Hello, everyone, and a very warm welcome to this week's major markets update for Friday, March the 29th, 2024. We are going from the short to the long-term charts, from the hourly to the daily to the weekly to even the monthly charts to see where we are at in each and every index. Well, not everyone, but most. So let's start here with the S&P 500. The hourly chart, this is the ending diagonal wave count we have been tracking. Kind of looks reasonable as a impulse as well, to that 53.50, 53.85 level. So we call it 53.50 plus or minus 50. All right, we haven't gotten there yet. So we'll see how we're going to get there. If this is an ending diagonal, it can be pretty tricky. We still have the potential here for a simple impulse, which requires a few more fourth and fifth waves to wrap this all up into oblivion. It all depends a bit on how the markets will react to today's CPE data. Some say it came in hotter than expected. It came in pretty much as expected. There was no real difference between last month. It's really a parsing out of the core levels versus the volatile levels, expectations. And of course, last month's data was revised up 0.1%. Spending was up for the consumers. However, income was lower and savings rate was lower. So a lot of consumers have been spending by eating into their savings, which is, of course, not a sustainable way of spending. So there's many ifs and buts. I don't know how the futures market is going to react to it. We'll see. But I think intermediate term, we'll keep an eye on these 53.50 plus or minus 50 levels with, of course, our warning levels. All these upside targets are always contingent on holding above key support levels, key overlap levels, our warning levels. The first one in blue, the second one in gray, the third one in orange, and the fourth one in red. So far, for almost ad infinitum, all the bears have done is break below the third warning level. It's close, but no cigar. We need to get below those fourth warning levels to really tell us that the top has been struck. And as long as they're unable to do it, we will look higher. I think we've had this number of 53.45, 53.85 on the map for a while. So we'll see how we're going to get there. Okay, this is then the daily chart with the trend line here since October 2023. And as you can see, we did dip below it here in early March. We did dip below it again on Tuesday, but the market again found some strength to recover itself. So key level of course, is then that green uptrend line since the mid-January low. Again, we're above all these warning levels. We keep the same warning levels. Yes, negative divergence is nauseating. It is definitely concerning that the change in money flow here in the bottom, CMF20, is now negative. Money is flowing out of this market. The MACD is definitely not looking healthy. And the RSI-5, which is a better tool for wave counting than anything else, doesn't look too strong either. But price is the final arbiter, and we haven't reached the ideal breakout target zone yet. So we can easily get there, which of course aligns with this 53.50 plus or minus 50 zone. Okay. Then we're going to go to the weekly chart. Now, the weekly chart, as you see here, has some vertical blue lines. Why do I show these vertical blue lines? Because we have now negative divergence on the money flow indicator on a weekly time frame. Since 2018, we've had some of these occurrences as well. The largest one here in 21, but it's not kind of similar. The most similar setup we have is here in 2017, going into early 2018. We had a spike and then this lower high, and we got the 2018 10% correction for 2 weeks or something like that. So that's very possible. So this starts to look kind of similar. We had similar idea here then once again in the summer of 2018, a similar setup here in the winter of 2019 and 20 as well. So this one's a little different, as there was also here a lot of negative divergence. And currently we don't have negative divergence on the weekly RSI 14. Okay, we don't. So this still looks similar to what we had here, right? It looks similar to what we had here. Also here we had no negative divergence there. So you see the lead up is kind of similar. So this starts to suggest that we are then in for a potential correction. Now, so far, we've only done 7 waves up on weekly down weeks, so to say, and we need to see 9 to complete an impulse. Again, if history repeats itself, I know it never does, but rhymes, we're kind of similar again to what we saw here. So here was no negative divergence, it's very overbought. No negative divergence, essentially, just pretty overbought. We did have some divergence here between the top, but once again, I want to point out similarities of money flow. This one was definitely different, the 2021 setup. But the whole bottom line is that, yes, we see now higher prices on less money flowing in, also on a weekly time frame. If I plotted the CMF, I like that one as well. It's a very good indicator. We do see that we have a little bit lower money flow, but still very strong. Okay, still very strong. As you can see here, we have these peak levels. So they kind of go inside with, okay, well, we might start to see a pullback soon, which matches with our wave cuts. Right? Let's go over here. We have this level there. We have a peak there. And we have a peak there. See that? That's kind of similar type of setups, these peak readings. Here as well, it's not as high a peak. But also what you see here, we have, of course, in this perspective, positive divergence there. So it does suggest we're going to go higher after this pullback. This is the monthly chart, monthly candles, and we did break above this trend line. That was simply based on 2 intra-month closes, or highs, sorry. So I think this kind of diagonal point of view is off the table. We still have this potential negative divergence on the monthly RSI 5. We still have this potential negative divergence on the monthly RSI 14. And of course, this potential negative divergence on the monthly money flow. So lots of negative divergences, but as you know, those are conditions, not triggers. What is important though, is that the monthly chart shows us the index is trading at the upper Bollinger Band, and the Bollinger Band are expanding. It is above its 10-month, its 20-month, its 50-month, its 100-month, and its 200-month moving average. So that is definitely a strong market. Okay, that is really the key point that I want to bring home. This is still a market that doesn't look like it has topped out. You could easily see a down month and then higher on more negative divergence. But please remember, most of the time you have the strongest RSI 14 reading at a third of a potential third wave. So this would then be, say, major 3, right? And then we have ABC 5. This is major 4. And this would then be primary 3. And this would then be primary 4. And we're now in primary 5. Okay? Similar with money flow. Money is the strongest, of course, at these third of a third wave level. But I didn't want to put in any wave count, just to show you from a trend perspective, this is a 100% strong bull market. So I have 0 signs that the top is in place. Let's move on to the NASDAQ 100. Well, the price action, of course, over all of March has been horrendously ugly, which does suggest that this is indeed also a ending diagonal wave structure, right? We're pretty much back here to where we were late February. So this is a whole month of nothingness. Now that's a little bit disappointing, I guess, but this is really what we have to deal with. And it does suggest that we should see a last C wave higher for 55553. Alternatively, we did have topped. It is very possible to count it that way. It would be unorthodox, quite uncommon to top this way, but it is possible. So we'll see, of course, on Monday, already futures market probably on Sunday afternoon, how we're going to resolve itself with, of course, the preferred wave count for this step higher, which would match with the S&P 500. But again, we're going to watch these warning levels. And so far, the index is struggling with this blue warning level on the hourly time frame. And I still would like to see, ideally, 18,100, and a nice CSA relationship would do it. From a daily time frame, 18,615 would look a little bit better for a 5-1 relationship. And maybe we'll get 1, 2, 3, 4, and 5. We'll get that out of the way pretty soon. Of course, the negative divergences are also on this chart blatantly nauseating, right? It is really not a good looking chart from that perspective. There's no strength in this market at all. Other than that, the price is still above the 20-day, the 50-day, the 200-day, the Ichimoku cloud. So it's still a 100% bull market. Okay, so we are below the first warning level, that's for sure. But not the second, not the third, definitely not the fourth. If we do go below those, I think this major 4 is underway, and then a major 5 should happen. RSI 5 doesn't look too great. MACD also doesn't look great. The last time we had the buy signal was here late February. That's it. So again, if you say, I can't use the Elliott Wave for my trading, I'm going to use the MACD. Okay, use the MACD. Well, then you've not been in the market pretty much for a long time, right? You would be stopped out here. You're not in the market. You would catch some of this. You'll get some of this. You'll get some of this. And then again, it does start to falter. Nothing works all the time. Money flow index doesn't look too good. All these divergences are divergence tilts. Now, we must point them out. This does not look happy. Look at the CMF. The CMF is negative. Most of the time, we see negative regions in downtrend side. This is quite weird. You see this, how money is really flowing out of the market. Can always completely turn around in 1 day, right? Or 2 days. That's it. But for now, we'll keep tracking the wave count as is. It does suggest a little bit more upside would look really great. Counter all these negative things we see in the chart, other than that price is the final arbiter and still in a 100% bull market. So focus on price. Everything else is just a canary in the coal mine until we add another canary. So let's say, now, to add a further insult to injury of these negative divergences, this is the weekly chart for the NASDAQ 100. We have now reached this ideal wave 5 target zone, as you can see, but we can still go a little bit higher. It's absolutely possible. Also, this one, we're above the 20-week, the 50-week, the 200-week. All of them are rising. Let's throw in the Ichimoku cloud if you so desire and see what we can get with that one. Okay, we add the Ichimoku cloud in. As you can see, looks even better with that one. There's still a 100% bull market. Okay, throw all this negative divergence out the window. It is still a bull market. As you can see, we are, of course, now in declining strength as price goes higher. Money flow is still pretty strong, okay? It is, but also negatively divergent. So it starts to look a little wobbly again. Once again, doesn't look too good, but hey, the trend remains our friend, and we need to see further breakdowns that is below, not even this week's low, but the prior low at about 70,750, 70,750 probably better, to see really this black wave far underway. Dow Jones, also this one adds second insult to injury of this insanely complex expanding ending diagonal. It's only ABCs. I cannot count this in any form or fashion as the impulse wave up. Not at all. It is all ABCs. So we have to really watch for these breakdown levels. And all we did was stall at the second warning level. That's it. And now we're back, and we can easily target 50,550 for this potential C/3 in black or in red. It all depends on the wave degree, how you want to count it. It's fine. It could be a C wave or a third wave. Most likely a third wave, in my humble opinion. Regardless, we're at the upper Bollinger Band. Okay, we are at the and above the 20-day moving average, 50-day, 200-day Ichimoku cloud, still 100% bull market. Zero indication that we have topped. Zero. I cannot tell you that we've topped. I cannot. Other than price action is horrendously ugly. All of 2024 is an insanely ugly price action. It doesn't make my job any easier. But hey, you know what? I don't make the market. I ask for easy price action, but not necessarily what I get. That's the unfortunate nature we're dealing with. And here you can also see how negative divergence can get erased. You see that? So everything's still 100% bullish. That's really the bottom line. So Dow Jones, from a weekly chart perspective, can do this 3, 4, 5. And as you see here in red, wave 5 of 5 of 5. targets ideal wave 5 target zone. Okay, so the red wave 5 is a degree lower as the black wave 5, which is a degree lower as the blue wave 5, which is the degree lower as the supercycle 3. Now we do have potential negative divergence now on this weekly RSI 5, but we need to see a down week to confirm that better. Okay. Money flow, similarly, as I pointed out for the S&P 500, starts to look not so great. Okay, as you can see here, we topped also here, and then you get lower money flow. It means less money is being put into this market. So getting pretty close for a potential third wave top, right? Potential third wave top. Maybe a little bit higher, as I said, could be a little bit higher into the low 40,000s, and that should be it. Monthly time frames can still be this ending diagonal, right? It's all a little bit contingent on how exactly we draw this trend line, this upper trend line. Okay, and third waves in a diagonal tend to target 123.6 to 138.2% extension. Also here, lots of negative divergence. This was the third of the third wave. Okay, so this was probably major 3, major 4, or so primary 3, primary 4. It all depends on how you exactly label things. We have this potential negative divergence, but that's not been confirmed. Money flow as well, all looks ugly, but price is ignoring it. It is at the upper Bollinger Band. It is above the 10, the 20, the 50, and the 200-month moving average, and all of them are rising, so it's still 100% bull market. End of story in that sense. So watch those warning levels on the daily time frame and see how this resolves itself with the potential for 1, 2, 3, 4, 5 up. Okay, like that, or we see just a ending diagonal. Fine with me either way. They do tend to resolve higher eventually into here the 42,500 plus minus 1,500. For those of you who have been with me for a long time, I've had this chart up there for a long time as well. So this is still unfolding pretty nicely. Let's go to the semiconductors. Yeah, we have no real answer to what exactly is going on. Now, I think I'll have to relabel this blue wave 5. This might just be a wave 3 instead. And I'll show you that in a minute using the monthly chart why that is. But that a potential larger, deeper correction fourth wave is underway, as shown here, A, B, C. I can't tell you yet what's going on because we haven't gone anywhere since the last 1, 2, 3, 4, 5, 6 trading days. Stuck here, and I need to see resolution above or below warning levels, right? These are the warning levels. We're still below the blue, below the gray, below the orange, below the red. I can't tell you, so this is still preferred wave count. And then alternatively, we're going to go higher, something like this. And then we're going to go to 4 here, and then another wave 5. I'll show you that in a minute. 4, 5. Okay, 1, 2, 3, 4, 5. 3, 4, 5. Very possible. So let's see how we're going to respond on Monday, to be determined. Okay, it's not a much resolved chart since 6 days ago. IWM, this was the wave count we were tracking, and we've been proven wrong on that one. I apologize, but we did have our alternative in play, and we knew that we had to stay below these warning levels. Remember, these are the bearish wave count, and we already broke above the blue one, the gray one, then the orange one, and now we also broke above the red one. So we can now ditch this wave count and go to this also ending diagonal wave 5 of C of B. 1, 2, A, B, C. A, B, C, and then A, B, C. It's all ABCs, right? So far, so good. Very ugly price action as well, all of 2024. Similar to the Dow Jones, similar to S&P 500 as well. As you might recall here, this is ugly price action. It is trending higher for sure, but it's all ABCs. So, with that in mind, let's then go to some of the market breadth indicators. We still have this potential negative divergence developing on bullish percent index for the NASDAQ, as well as for the S&P 500. But I did want to point out that this negative divergence is starting to be erased. Now, finally, at long last, we have a new all-time high in the AD line for the NYS key. Yes, finally, we can take this concern off the table. We've been tracking it for a long time. It took a while, almost as long as in 2009 to 2010. So we can take this off the table. This concern has been erased. So that's one concern less. So we're now at new all-time highs in the 18 line, which is good, which does also suggest we should see higher prices even after pullback. However, the new high-low indicator is still diverging as it did in 2000, as you can see here. So this one remains a concern. We did get away with this one. That's great. Don't have to track that one anymore, but this remains a concern. How we're doing on the McLellan oscillator for the S&P 500. McLellan oscillator measures the number of advancing and declining stocks, and those that remain, of course, the same, and they unchanged. And then, of course, makes a ratio out of that. And then we find it is currently at 29. It's positive. It has been an ugly advance since January, that's for sure. But it's positive, so more stocks are advancing and declining. As such, the summation index, which is a cumulative number of the McLellan oscillator, is back to a buy since late February and remains on a buy, but we have not made a new uptrend high. So we still have this potential negative divergence developing. Okay, we need to see now a sell signal to confirm it. That's then a reasonably bearish signal. Again, you can see this advance here is not that of a impulse, but that of a ending diagonal. I mean, if you look at the line chart for the S&P 500. Let's look at the PMO buy or sell indicator. Well, I haven't seen it this bad in a long time. Also, this one really shows us how erratic underlying market has been with no clear buy or sell signals other than the one we got in January. And you can see here we had this pretty bad sell signal in late February into March. So the underlying market is still not very stable. Seems to be a tug of war. One stock is advancing today, then the other one tomorrow. But in general, the trend is kind of higher. This is an ugly one, hasn't been working for a while. Again, back to the MACD, as I pointed out earlier in the presentation, shows you that nothing works all the time in the market. There are sometimes indicators that just don't work. They fail to work, and eventually they will get back on track. It's just the way it is. Nothing works all the time in the market. Same with Elliott Wave. Nothing works all the time. Okay, let's look then at sentiment. Sentiment is quite bullish, but that's not necessarily the end of the world. Money managers are once again over leveraged, 103.88. So they're 3% over leveraged. We've seen that before. Okay, you can get more over leveraged, and that is again not the end of the world. But we take it into consideration, and it means like people are quite optimistic. Similarly, again, a lot of optimism out there in the AAII sentiment indicator. And if we scroll down, we find that this bullish sentiment is now unusually high for the 21st consecutive week. So 21 weeks did we see unusually high sentiment, and it's done nothing to the market. Okay, so please keep that in mind, that this is not always a contrarian indicator. I want to see it almost 60% bullish. That's a very strong sign. Then we're really far away from what is normal. Normal is about 2/3, I would say, bullish to neutral, and 1/3 is bearish. So this doesn't tell me too much yet, but it is definitely a little bit frothy. That's about it. Also, the fear greed indicator remains in greed, but we've been in greed for over a month now. So again, didn't do anything to the market. Last but not least, this is the seasonality index, so to say, for the S&P 500. We only look at election years. And here you can see why I was looking for a dip at around March 27th and then a rally into the beginning of April. So we had this dip here in the 27th, which was Tuesday. And then we should rally, and then we should decline into May. So we had a dip here as well into March 14, 15, which we got. So we should now be in this uptrend and then slowly decay, sell in May and go away. Or maybe we see that wave 5, as I pointed out, from Dow Jones and the NASDAQ 100 appear. And that will then, of course, will also find its way into the S&P 500 and in the semiconductors as well. Remember the semiconductors chart 4 or 5. So seasonality does point to a pullback pretty soon as well, but we might see those higher prices first. Again, I have no indication that We'll see lower prices first. Let's see on Monday where we open, what's going to happen. All those good things. But again, I'll keep my eyes on the price, which is a 53.50 plus or minus 50 target zone, because I have zero indication it will not be reached for the S&P 500. That should sum it up. Take care, trade safe, catch you all next week.